Good evening, class, and welcome to our taxation for ATS3. The last time we held our class, we talked about taxation of employment income, and we talked mostly theory, how the taxation of employment income is, what is a Nigerian income, a foreign income. We talked about contract of employment, contract for employment. We talked about mostly cash benefits, or we call it cash remuneration. Today we'll be going to something called benefits in kind. Now, because we said that your employment income is divided into cash benefits and non-cash benefits. So the non-cash benefit is the benefit in kind. These are things that you get, the benefits you get as an employee that is not cash related. Now we have examples include the use of assets. Now, what are some of the use of assets that is valued as benefit in kind? We talk about assets that is owned by the employer, but the employee is the one enjoying it. Take, for example, there is company car. The company car is owned by the company, your employer, but it was given to you as the employee to enjoy. You didn't buy the car, but you were able to enjoy it because it's a benefit to you as an employee. We also have house that you stay in, and this house is not rented by you, or the house was is owned by the company, but you are staying there without paying rent. We also want to talk about maybe you have a company car and they employ a driver, sometimes called a chauffeur. Then you also have a cook, a gardener. All these are benefits in kind. Now let's look at where we talk about assets such as motor vehicles, furnitures and fittings, plants and machineries. Now this is owned by the employer, but the employee is the one enjoying it. So because the employee is the one enjoying it, the employee is deemed to have derived an income from the enjoyment of it. So it cannot just be, it's not you're not just enjoying the car that the office is giving you. That car the office is giving you, the the tax authorities is taking it that you have enjoyed income for the use of the car. Now, if the asset, say a car or the machine, if the cost is known, if the cost is known, that means the historical cost, the cost that they originally bought it in the market, you need to charge 5% every year of that asset. Now, if the cost is not known, what you need to do is to get the market value of that car as at the date of acquisition. So it means that if you don't know how much the car is, now you check when was it bought. Maybe it was bought 2 years ago. How much do you think this car was worth 2 years ago? Now you take it that that is the likely cost of the car, and it is going to be charged by the tax authorities at 5%. So now what we will say here is that most especially you will see for car, for car, you charge 5% of costs. 5% of costs. So that's it. Now, if an employee is provided with assets where the employer has paid a hire or rental charge, now that rental charge is going to be seen as the income of the employee. So it means that if they hire an asset, say they hire a car for the employee, is different from when they buy the car. They hire the car and the employee is enjoying the car. Now that cost of hiring of the car is seen as income in the hand of the employee. It also means that if they pay a house rent, okay, we'll talk about house rent later. So if they hire an asset, this time we say a car, as a typical example, the cost of hire of the car is an income to the employee. Now, assuming the employee has paid part of it, or he has made a refund for some of it, that refund will be used to deduct whatever was paid by the employer so that the difference is the income. All right. Then we'll go now to provision of residential accommodation. Now, this is house. Now, if the employer provides residential accommodation for the benefit of an employee anywhere in Nigeria, the employee pays no rent for the premises. Now, if he pays no rent, or if he pays rent, it is less than the annual value of the premises, the employee is deemed to have derived income each year equivalent to the annual rateable value of the premises. Now, they will say, so what we mean here is for accommodation, accommodation, you look for annual rateable value. So when you look at the annual rateable value, you will know. So let's say, for example, you are given a house at Ikoyi, and the rateable value of the Ikoyi house is 2 million a year. Okay? Now you are staying there for free. You are not paying the house rent. But the person who paid that 2 million is your boss or the company. That 2 million is seen as income in your hands. Now, suppose you rent it for 1.5 million. When the tax authority look at it and they see that, oh, this house is 2 million, the rateable value is 2 million, but now you are paying 1.5, they will say no. Whether you like, you pay 1.5, they are taking 2 million as income in your hand. So if your rateable value is bigger than what you paid, the tax authority will take the rateable value. But what if what you paid is bigger than the rateable value? They will take what you paid because they want more income. The next one is domestic staff paid by the employer. Okay, so I usually look at this play in television called the Johnsons. I use it as an example. Let's say the domestic staff of Mr. Johnson, he has a cook, he has a maid, he has a driver, he has somebody washing, a washman, and now his company is the one paying those staff, but the employee here is enjoying the benefits. The salary of the domestic servant shall be seen to be income in the hands of the employer. So it means that as they pay the domestic servant, they will not charge them tax. They will see it as income in the hand of their oga, and the oga will not be the one paying tax. Now, there is a note of caution here. The income of a domestic staff shall only be deemed as income in the hand of an employee only where the domestic staff is not a permanent employee of the employer. That is a contract staff. So if the cleaner, the maid, and others are contract staff, but the company is the one paying them, then the person who is enjoying the benefits of their service to be their income in his hand. But if they are permanent staff, then they will answer their own name. They will be paying their own tax, and it will not be seen as income in the hands of the other employee. Now look at benefits exempted from tax. Benefits to employees exempt from tax. Now, these benefits are also benefits in kind, but they are not taxable. Expenses in connection with the provision of meal in any canteen. Now take note, for all staff, or provision of non-assignable luncheon voucher. So when you are providing meal for all staff in any canteen, as long as you have the evidence of the purchase of this meal and you have it to show as evidence, this is a benefit in kind for your staff. But your staff will not be, it will not be seen as income in their hands, and it will be taken as a, for the employer, it will be a tax exempt expenses. So this provision of meal is not seen as income in the hands of an employee. Then we have expenses in connection with provision of uniforms, overall, or protective clothing. Like in the armed forces, we have uniforms. In the lab, we have overalls. In the construction site, you can have protective clothing. Now, the employee is the one enjoying this clothing, but who paid for them? The employer. The employer paid for the boots, paid for the hand glove, paid for the helmet, but the employee is using it. Because the employee is enjoying it, it will not be an income in his hand. Then there's another one, expenses connected with employee's change of residence as a result of his change in his employment. Now, let's say you are in Lagos and you are being transferred to Abuja. Now, because you are transferred to Abuja in your same company, you now made expenses. Your boss now paid for your flight ticket. He paid for carrying your load because he's the one sending you on transfer and all that. This is a benefit enjoyed by the employee. It is not going to be seen as income in the employee's hand. Now let's look at what we call gross emolument or gross income. Now, gross income means wages, salaries, allowances, including benefits in kind that you are deriving by reason of your employment. It means that anything you get in your employment, as long as they are, so we can say gross income, let me say gross income is equal to cash emoluments plus benefits in kind. Now, this is the first definition of gross income here. Now, gross income means income from all sources, income from all sources, less non-taxable income. Now, these are income on which no further tax is payable. Tax exempt items listed in paragraph 2 of the sixth schedule, all allowable business expenses and capital allowances. So now you will say your gross income now will now have a new definition. Cash benefit plus benefit in kind minus tax exempt income. We call it non-taxable income. So tax exempt income are also called non-taxable income. Now, what are some of those non-taxable income? We will need to go to section of the sixth schedule, paragraph 2 of the sixth schedule. Okay, so now we go to tax exempt deduction. The following deductions are tax exempt. We have National Housing Fund. We usually call it NHF. So if you see NHF or National Housing Fund, it says that provides that a Nigerian earning an income of 3,000 naira and above per month in either public or private sector shall contribute 2.5% of his basic salary. So the law says 2.5% of basic salary. All right. Any employer who fails to deduct or remit the NHF is liable to a fine of how much? 50,000 naira. While self-employed persons are to pay 5,000 naira or 1 year imprisonment on conviction or both. Now, the employer is to deduct the contribution from the employee's monthly salary and remit to the Federal Mortgage Bank of Nigeria within 1 month of making the deductions. Now, that's one. Then we have National Health Insurance Scheme. We call this one NHIS. NHIS. Now, the NHIS was set up by the National Health Insurance Act for the purpose of providing health insurance, which shall entitle persons insured under the scheme and their dependents the benefit of good health. Now, the act provided that an employer who has a minimum of, now there's a minimum of 10 employees may, together with every person in his employee, pay contribution under the scheme and at such rates as determined from time to time. Now, in the public sector, that is the federal, the employer is expected to pay 3.5%, while the employee pays 1.75%, which everything translates to 5% of the employee's consolidated salary. So the gross salary consolidated, 5% is taken as NHIS. So I will come here and I will say NHIS by law is 5%. 5% of salary, consolidated salary. In the case of a private sector or other tiers of government apart from federal, the employer is expected to pay 10%, while the employee pays 5%, representing 15%. So we can say or 15%, or 15%. So the 5 is for federal, the 15 is for others. Now, it is noted here that the employer may decide to pay the entire contribution. Sometimes the employer may undertake extra contribution for additional cover to the benefit package. So it's possible that instead of the employer to pay only 10% and the employee pays 5%, the employer might pay everything. It might even pay more than 15%, it might even pay 20%. So that's it. An employer under the scheme shall cause to be deducted from the employee's wages the negotiated amount of any contribution payable by the employee. Now we have what they call life assurance premium. A deduction of the annual amount of any premium paid by the individual during the year preceding the year of assessment to an insurance company in respect of insurance on his life or the life of his spouse. So if there is a life insurance paid last year, okay, say 2023, you paid maybe 100,000. Now when they are doing your 2024 tax computation, that life assurance premium will be deducted. Then we have National Pension Scheme. The National Pension Scheme establish a uniform contribution pension for payment of retirement benefits to employees. Now, the scheme applies to all employees, both public and private, who are in employment in an organization where there are 15 or more employees. Now, the rate of contribution to the scheme shall be a minimum of 8% of the employees' monthly emolument. Monthly emolument. Now, the monthly emolument is basic, housing, and transport. I usually call it BHT. So, I would say National Health Insurance Scheme is 8% of BHT, basic, housing, and transport. This is your monthly emolument. Every other thing is jara. Any other allowances you get is not your monthly emolument. Now, the private sector, for the employees, the employer will pay 10%. Okay, sorry. The rate of contribution shall be 8% of employees' monthly emolument as contribution for employees in the public sector, and private sector shall be 10% of the monthly emolument as employer's contribution. So what it means here is this: 8% is from employees, while 10% employer. So everything here, 8 plus 10 is 18% is what is sent to the pension. All right. However, contribution made by an employee to the scheme shall be tax deductible. It says, notwithstanding the foregoing mode of contribution to the scheme, an employer may agree to elect to bear the full burden of the scheme. So it means that this whole 18% can be paid by the employer. The employer contribution shall not be less. The employer's contribution shall not be less than 20% of the monthly emolument of the employee. So if he's taking everything, it should not be less than 20%. So it means the minimum is 20% if he's taking everything. Or if he's taking parts, he's going to pay his own 10%, the employee should pay his 8%. Then there's gratuities. Gratuities is money paid to an employee who is retiring or leaving his employer after several years of service. Now, gratuity is tax deductible. So when you pay your gratuity, that gratuity that you receive, that bulk money they pay you when you retire, this is different from pension. Pension, they pay you monthly pension. Gratuity, they pay you one lump sum. And that's it. Now we have something called consolidated relief allowance. Consolidated relief allowance. Now, consolidated relief allowance, we sometimes call it CRA. Now, CRA is gross. Now, gross income, we said, means income from all sources less tax exempt items. Now, consolidated income, gross consolidated relief allowance is granted at the higher of 200,000 or 1% of gross income plus 20% of gross income. So what it means is this: when you are calculating your CRA, you will need to first of all compare 200,000 naira or 1% of gross income. Whichever is higher, you pick. Then plus 20% of gross income. That's it. We'll see an example later. Now look at the rate of tax. Having ascertained the reliefs and allowances claimable have been deducted from the total from the income of all sources, we now arrive at something called chargeable income, to which graduated tax rates are applied. Now, it means now, look at the tax rates for your first 300,000 naira, you will be paying 7 kobo per 1 naira, or is as good as saying paying 7%. Now you go to the next 300, that means they've divided your salary. The first 300,000, maybe somebody is counting money. 1, 2, 3, 4, 5. And when they count 300,000, that's the first one, he's going to go and find 7% of that 300,000. Now that will give you 21,000. He's going to take 21,000 from that 300,000 and give you the remaining money. Then he starts counting again. 1, 2, 3, 4, 5, 6, another 300,000. He's going to go and take 11% of that, which is 33,000, and give you the rest. He goes again to count 1, 2, 3, 4, 5. Now this is 500,000. It's going to take 15%, which is 75,000, and give you the rest. Now by this time he has counted 1,100,000, and he has been collecting some money. He goes again to count the next 500, and he's collecting 19%, which is 95,000. So by this time now he has counted 1,600,000, and he has collected some money. The next thing again, he is counting the next 1,600,000. Remember, this 300 here to this 500 equals 1,600,000. He's counting around 1,600,000 again. When he counts that one, he says, okay, I'm removing 21%. Now, this 21% is going to be 336,000. Now, he has removed from this first 300 to this last 16, he has counted 3,200,000. And from here, 7% to 21%, he has removed 560,000 from 3,200,000. He now said, any income above 3,200,000. So that means he starts counting again. After he has counted 3,200,000, and if there's still money, he said, there's still money, he starts checking that money that is remaining. Any amount it is, he is going to remove 24%. We are going to see an example of how this is done. Now look at the format. Now we have our earned income. Your earned income should be your employment income. Now the employment income should include cash. This will include cash plus benefit in kind. Then it could also include gratuity, because if this a time when they are paying the person retirement benefits, they give him gratuity. Then it could also include income from trade or other sources. Maybe the person is a businessman, he has a shop, is trading, okay, or other sources of income. Now this is earned income. Then we go to unearned income. These are income that even though you don't work, you will still make benefits. Let me pause so far. Unearned income are income in which you do not need to go to work and stress yourself, but you are getting the benefits. You just do the work once and you are getting your benefit. For example, dividend income. Dividend is when you are buying shares, let's say GT Bank shares that is currently being sold. You buy the shares, and when they are declaring dividends or the profit or so, the profit that is being distributed to shareholders is called dividends. They will give you your dividends. Then you have rental income. Rental income is when you are a landlord. You have an asset, you have a house, you are renting it, collect rent. That rent is unearned income. Then interest income. Your interest income has to do with you borrow somebody money, or an institute money, or a company money, or even a bank, and they are paying you interest and capital. Now the interest that they are being paid is an income to you. Then there is royalties. Royalties have to do with something that is you are you earn as a result of your intellectual rights. We call that one patent rights. Royalties is something that how will I say it again? Let's use example of you are a musician and you sing and you get paid, or they produce your album and they are selling it and they are making money, they need to pay you royalties for selling your intellectual property or selling your song. Now that is an unearned income because you sing just once and your song is selling. Now when you add everything together, both the earned and the unearned income, you have your total income. Then you bring your non-taxable income. You bring your non-taxable income, then the income on which there is no further tax. The non-taxable income, if there are non-taxable income, you bring them from here. Income from which there is no further tax. For example, we have dividend is there is no further tax. Interest income, there is no further tax. You bring them now here. Yeah, you add them together and you are deducting it from your total income. What you have here is still your a sub is still a sub because you don't call it gross income. Then you bring your tax exempt items, which is your national housing fund, your national health insurance, your pension fund, your national health insurance scheme, your life assurance premium, and your gratuity. You bring them all here and you less them from this, and this is where you now get your gross income. So at this point, you have your gross income. You now be calculating your CRA. After you calculate your CRA, you have your chargeable income. It is this chargeable income that is subjected to tax. All right. Now look at another format. These are computation of income of an employee relating to trade and other source. This one here we did is income of these are personal income tax of an employee, okay, whether he is working or doing business, everything. This is the general format. But now this is the format for those that are in trade or other sources. Now you have net profits. Now when you bring your net profits, when you do your profit and loss statement and you have your net profit, to bring it down here, then you will need to add back some expenses that are not allowed. Then taxable income that you have not reported, you need to add them. When you add them, you are getting this. Then you need to deduct non-taxable income. Any non-taxable income in your income statement, you need to deduct them. Then you also need to deduct allowable expenses that have not been reported. When you do that, when you deduct, what you have now is adjusted or accessible profits. Now, when you get the accessible profits, you now bring any loss that you have from last year. Then, when you relieve the loss, the remainder is carried forward. Now, it is this relieved loss that is taken here to be relieved from the accessible profit to have something down here. Then there's something called balancing charge. Balancing charge has to do with when you sell an asset before the capital allowances are fully recouped. Or yes, before the capital allowances are fully recouped, you sell the assets and you sell it uh, below, above what the balancing, uh, what the net book value is supposed to be. That means you have made a kind of profit. So you bring it down here as a charge and they will add it up. Then you have your capital allowances brought forward for the year. Then if there's a capital allowance for the year charge, you bring it down here. Then if there's a balancing allowance now means you sell the assets. Now you're supposed to sell it for 2 million. but you sold it for 1.5. The 500 that is remaining is your balancing allowance. This is opposite to balancing charge, where they are supposed to sell for 2 million and you sell for 2.2. The extra 200 is a charge for you. Then we now relieve the capital allowances. Then this is income from trade and other sources. Now this is the income from trade and other sources that is being here. Income from trade and other sources. So that's it. All right, so now let's look at an example and let's learn from this illustration how we can solve these kind of questions. This is illustration 13.1. Now, the name of the employee is Mr. Yaya Ogunshowo. He's an employee of Cool Beauty Product Limited. Now, he has the following salary package. So, for the mention of the word salary, it means it is an employment income. For the year ended 31st December 2020. So now I know what the question is likely going to be. Let me scroll down and see the requirement. Required. Compute his tax payable for the relevant year. The relevant year is 2020 because tax employment income is at actual year basis. All right, so now let's look at it now. Let's go to illustration 13.1, Mr. Yaya Ogunshowo. So this is illustration 13.1. Illustration 13.1. Mr. Yaya Ogunshowo. This is computation of tax liability for 2020 year of assessment. So that's it. We are now going to do one naira sign here, do another naira sign here, and that's it. Okay, so let's go. Let's see what is being asked. We have salary 6,500,000. So I will come here and I will say earned income, and I will say earned income, earned income. So one of them here is employment income. Employment income. Under the employment income, I will now note there is salary 6.5 million. Okay, now this is the only thing that is mentioned with cash salary. So I will say under employment income, we have salary. Salary here is 6,500,000. Okay, the next thing again is, so that means we've done this. So salary 6.5 million is done. He enjoyed domestic servants, two domestic servants, and a night guard. Now, these are benefits in kind. So we come here, benefits, benefits in kind. Then we have night guards. Now, night guards, they said two night guards, they are paid 200,000. Okay, sorry, two domestic servants and a night guard. So since I've written night guard, it's not night guards, night guard. Now let me remove and put two domestic servants first so that we'll be going in line. Two domestic servants. Open the bracket. 2 times 200,000 each. That will give us 400,000 for the two of them. And there is night guard. There's night guard. How much is the night guard being paid? 150,000. So come here, 150,000. Okay, so we've done that. Now we are told, okay, so we tick them after we do each of them. We collected a sum of 88,250 during the year as reimbursement of traveling expenses. We said this is not allowable, this is not uh, taxable income. So we are not going to add this. He lived, so we are not going to add this. He lived in a company house rented for how much? 450,000 naira per annum. So, but once you see rent 450,000, so we have to compare, is this rateable? So let's compare. Is this rateable? Let's go down to see whether there is rateable. The rateable value of his residence is 250. So this is rateable. Now, he paid above rateable. So it's accepted. The company, he lived in a house rented for 450. So the company paid 450 above the rateable value. So it's okay. So you come here, accommodation. Accommodation, 450,000. Since it is above rateable, since it is not below rateable, it's accepted. Use an official car purchased at 3.4 million. Now, we know that we are going to take 5% of this. 5% of 3.4. So we will come here and say car, official car. We say 5% of 3,400,000. So what would that give us? 3,400,000. 5% of that. So we say 5 divided by 100, that's 5% of 3,400,000. That gives us 170,000. So we come here and put our 170,000. Now that's your benefits in kind. Let's see if there are more. Okay, there are no more benefits in kind. So what we will now do, we will now add this up. When you add this up, what do you have? I already have 170,000 in my calculator. So I will add just the remaining one plus 450 plus 150 plus 400 plus 6,500,000. And that will give me 7,670,000. 7,670,000. So I will take it down here. 7,670,000. Okay, so now this is my employment income. Then I will do, which other income does he have? He didn't do any business. So he doesn't have other business. We are told that he is married with two children of school age. That is not important for tax. Has an aged mother whom he maintained with 30,800 per annum. It's not important. So this is not important. This is not important. Now, these are the amounts he paid as life insurance premium. This is important. Dividends is another income. Dividends. All right. So look at dividends. Now, because we are dealing with 2020 year of assessment, dividend is an investment income. So I will come here and I will say unearned income, and I will say dividend, dividend, gross. Now, two things happens here when I say gross. We need to check whether these things given to us is gross. Now, they are telling us this is net of withholding tax. If you are giving net, you need to gross it up. So we gross it, gross it up. How do we gross it? There is already 10% removed from it. How do we gross? So anything we are seeing here, yeah, is already in net. How do you gross it up? You multiply by 100 over 90. Multiplied by 100 over 90 by 100 over 90 by 100 over 90. Now that's one. Secondly, because the year of assessment is 2020, dividend income is only going to be in the year before. So we're not going to take the 2020 anyone in 2020 because it is charged on preceding year basis. So this one in 2019 qualifies. This one in 2019 qualifies. This does not qualify. This does not qualify. So what we are only taking is this. So now let's look 99 plus 63. We are going to cross them up. We'll come here and say 99,000 plus 63,000 multiplied by 100 over 90. So how do we do that? Let's do that now. We have 99,000. Sorry. Is it 99? Let's see. 99 and 63. Yes. 99,000 plus 63,000. All of them are given to you in net. You cross them by multiplying by 100 divided by 90. Now it gives me 180,000. And that's the gross here. 180,000. This is 180,000. 180,000. Okay. Okay, I believe now that you can hear me. All right. So we have our 180,000 as uh, unearned income from dividends. So after doing all of that, from the format, we have added employment income. There is no gratuity. There is no other trade income. We have our unearned income. The only thing here was dividend income. We need to remove non-taxable income if we have them, or if we have income from which there is no further tax, we need to remove them. So let's do that. But before we do that, let's sum this one up to become total income. So let's sum it up now. We have 180 here already. Let me just add. Oh, we also have 7670. Let's just add the 180 to it. That gives us 7,850,000. So I'll write 7,850,000. Now we need to go now and remove income from which no further tax is payable. Example of that is dividend income. So we will now come and say less income for which no further tax is required. Remember, they give you your income, your dividend income, they give you as net. You were the one who grossed it up. So why did they give you net? They have already removed withholding tax. So there's no further tax that is supposed to be deducted. So they say you should less that. They will now say less dividend income gross. So you come here, that 180 that you added before, you will now remove it, and now you are left with 7,000,067. What do we have that time? 670,000. All right. Now the next thing to do is to remove your tax exempt items. There are five in number: one, two, three, four, five. Let's see how many of these we are given. Let's see how many of these we are given. We were told that he paid 48,000 as life assurance premium. 48,000. So you come here, less tax exempt deductions. We say life assurance premium. We have 48,000. Is that a monthly figure or a yearly figure? They didn't tell us it's per month, so it's monthly figure. Okay. Then we are not told, okay, the rateable value of his accommodation is 250. Yes, we've deducted it. Now, we were not told anything about National Housing Fund. National Housing Fund, we are not told about his pension. It's assumed here that it was not, we don't need that. Okay, so 48,000. So let's bring it down here, 48,000, and remove it. So when we remove 48,000 here, first of all, let's remove this 180,000. Now let's remove this 48,000. We have 7,622,000. 7,622,000. And this is what we call gross income. So take note of the step. This is gross income. Then the next thing to do is to remove something called less CRA. Now CRA, we said it is 200,000 or 1% of gross income, whichever is higher. So let's check. Let's look for 1% of gross income. This is our gross income. Let's look for 1%. We say times 1 divided by 100. This is 76,220. This is far less than the 200,000. So you take your 200,000 here. This is 200,000. You now say plus 20% of gross income. So what do we do here? This is the gross income here. Let's look for 20%. You say times 20 divided by 100. This is going to give me 1,524,000. 1,524,000. When you add these two, it will give you 1,724,000. Now this is your CRA which you are going to remove. So this is, if I add 200 to it, this is 1,724,000. Now if I were to remove it from 7,622,000, okay, I'll be having 5,897,600. 5,897,600. Now that is going to give us 9,000,000, 5,897,600. Now we call this chargeable income. Chargeable or taxable income. Now this is what goes for tax. So what do we now do? You will now come and give your tax. Now say tax liability. Now you take the first 300, the first 300,000 at 7%. That means this is 21,000. The next 300,000 at 11%. This is 33,000. The next 500,000 at 15%. This is 75,000. The next 500,000 at 19%. This is 95,000. The next 1,600,000 at 21%. This is 336,000. Now I want you to do something for me. If we are to add all of these, I should be getting 560. Let's see if we are correct. 21 plus 33 plus 75 plus 95 plus 336. And that's 560. That's fine. I can come here and say this is 560. Then, if you are to add everything here, you would have gotten 3,200,000 at this point. Let's see. 300,000 plus 300,000 plus 500,000 plus another 500,000 plus 1,600,000. Now that's 3,200,000. Now anything in excess of 3,200,000, we have 5,897,000. You will now say balance of, so you will now remove 3,200,000 from it. I'll put my negative here. 5,897,600. If I remove 3,200,000 from it, we will have 2,697,600. 2,697,600. Balance of 2,697,600 at 24%. The answer will be here. So we look for 24%. That will give me 647,424. 647,424. So you will now add them together. Let me add it to 560 plus 560,000. I have 1,207,424. 1,207,424. And this is your total tax liability. That's your tax liability in this question. We have a difference between the way they solved it here and the way I solved mine. I wonder where the difference came from. Let's see what's the difference. They have 7470. Let's see. Oh, that may be where the difference came from. The difference here is the difference is in accommodation they use 250 and I use 450. That's the difference. Now, which one of them is correct? Either of the two is correct. Either of the two is correct. But looking at it from the standpoint of the taxpayer, the taxpayer will likely take 250,000 to compute. From the standpoint of the tax authority, they will want to take 450. So if you present 450 to them, they will accept it. If you present 250, they will accept. Now, another thing, why would a company pay 450,000 for an accommodation that is 250,000? So what the company has paid is what the tax authority will choose. So that's why I put 450,000. But if this 450,000 was lower than the rateable value, that is when the rateable value will be here. So, but either of the two, you are correct. But in this case now, this is the tax 1,169,000. This is 1,207,000. So the tax authority will like more money. This is from their own perspective, and this is from the perspective of the tax authority. So any of them you use, you are correct. All right. So that's where the difference is. Every other figure we put here are the same. They are the same. The gross dividend is the same. Yes. Everything we did was the same. The other difference again we will get is our CRA will be different because of our gross income. Our gross income figure give rise to what we have our CRA. But everything you are doing, you get 100% if you do it the way I did. Now, minimum tax. Where there is no chargeable income for an individual, or where the tax that is payable is less than 1% of his total income, the individual shall be charged at the rate of 1% of his total income. In essence, the minimum tax rate is 1% of your income, of your total income. So what they mean here is, look at your total income here, or chargeable income, your minimum tax, look at what you need. This is 5,897,600. But we are to charge minimum tax, minimum tax is 1% of 5,897,600. 897,600. So let's see what it will be. 5,897,600 times 1 over 100. That will give me 58,976. 58,976. This is the lowest tax you can pay. You cannot pay anything lower than this. But now look at what you are paying, 1 point something million. So, but this is your minimum tax. Now, why minimum tax? Sometimes you may find out that you may have no taxable income. You may have no taxable income because you have large personal benefits, or your tax is lower than your minimum tax. So your minimum tax is going to be applied. Now, there is an exemption. The minimum tax shall not apply to person that earns the national minimum wage. All right. Now look at this example. The details of the employment income of Mrs. Buki Yusuf, a clerical officer in public institution for 2021 assessment year, is as follows. This is his consolidated salary per annum. It's 360. This is what is his salary for the year. Then contribution pension scheme is 8% he paid. Contribution to National Housing Fund is 2.5%. Now, Mrs. Yusuf is a divorcee, lives with 3 children, has an agent uncle, he spends 1,500 per month for his upkeep. All these are not important. They are not important, so you don't make use of them. Now, how do you compute the tax liability? Let's see what is done here. Look at his earned income, salary. His consolidated salary is 360 as given. He has no unearned income, so no rental income, no dividend income, no interest income. Now, tax exempt items. We have our pension scheme. We said the pension is 8%. And so they calculate 8% of his consolidated income, which is like housing, transport, and basic. And we got 28,800. Now the National Housing Fund is 2%, 2.5%. It's supposed to be 2.5% of his basic, but we are not giving basic. So you are using 2.5% of everything here. It gives you 9,000. When you add these two together, you are having 37,800. Now, when you less 37,800 from 360, you are having 322,200. Now that's fine. Then this is your gross income. So I'm going to write here gross income here. This is gross income. This figure. Now, your consolidated relief allowance, 200,000 or 1% of this. Of course, 200,000 will be higher. Now, let me tell you something. When you are doing your CRA and your gross income is less than 20 million, don't bother doing comparison, just take 200,000. But if it is more than 20 million, take the 1%. Let's test it. Let's look at 20 million. Look at 20 million. Find 1% of 20 million. You say times 1 divided by 100. It will give me exactly 200. So it means that any gross income that is less than 20 million, it will give you 1% of it will give you less than 200. Anything above 20 million, 1% will give you higher. We say 20 million 100. Let's see. 20 million 100. Okay, this 20 million. This 20 million 1,000. If you find 1% of it, 1 over 100. This more than 20 million. It's more than 20 million by 10 naira. So it's anything more than 20 million, it will be better you use 1%. So in this case, this figure is less than 20 million. You just take 200,000, you add your 20% of one of this same figure, and you have this. Now this is your gross, your consolidated relief allowance. But you now remove this 264,440 from 322,200, your chargeable income. So this is your chargeable income. Now chargeable income is this. Now, this tax liability, why is it nil? Why are we not charging 1%? 1% of 57,660. Why are we not charging that? Because he is earning minimum wage. How do we know he's earning minimum wage? If your salary is 360,000 in a year, you are earning minimum wage. What is the minimum wage of Nigeria? The minimum wage right now is 30,000. Now, if you multiply 30,000 by 12, what do you have? Let's see. 30,000 multiplied by 12 gives you 360,000. So that's the minimum wage. Now, until government approve it, for now, government has said minimum wage is 62,000. Let's assume that it sticks. Let's assume now that it is agreed. That will mean that 62,000 times 12. Anybody that is earning 744,000 is not going to pay any tax. And that is what they are saying. All right. So at your own time, I would like you to read the offenses and penalties for failing to file tax and all that. I want you to read them on your own. Now look at the chapter review. What have we learned today? We have learned taxation of employment income under the pay as you earn scheme. Then we have seen the laws that relate to reliefs and allowances. We saw consolidated relief and allowance, which I told you that if it is not up to 20 million, when you are doing CRA, just take 200,000 plus 10%. But if it is more than 20 million, just take your 1% and 20%, or in fact, just do 21%. That's it. We are also told that there are other tax exempt items such as National Housing Fund, which is NHF, National Health Insurance Scheme, and we have pension contribution, life assurance, gratuity. All these are tax exempt items that you need to deduct before you get your gross income. Then we saw personal income tax liabilities are computed after reliefs and allowances, including tax exempt deductions, are deducted from where the earned and the unearned income. And we saw the rate of tax from 7% down to 24%. We also saw minimum tax, which is 1% of your gross income, of your total income. Okay, so we are going to be doing this on your own, this quiz on your own. Then you are going to do this assignment and submit. Number one and number two. If you can do the three, then that's fine. If you can do the three, that's fine. I want you to practice these things. Anyone you have issues with, let me know so that we can deal with it. So your assignment is this question. So this is assignment. Assignment. This is number one. This is number two. And this is number three. So wow, they have even four. This is number four. Do the ones you can. I would like you to try all of them, attempt all of them. Anyone that you can't, let me know. But attempt them. Now your strength in the exam will be felt when you make attempts in solving questions. So that's how far we can go today on personal income tax. Feel free to check the past questions and see how you can solve some other ones in the past question on this topic. You have 1 week to do all of these. This topic will not fail to come to your exam. It will not fail. I said it again. It will not fail. So use the format we've learned today to solve these four questions. Make sure you get them. Then you will be making yourself strong for this exam. So thank you so much, and the recording will be shared with you as soon as possible.